welcome to Property Question Time. I'm your host, Taylor Welch. This is the show where you get to ask your property-related questions to our panel of industry experts. I'm joined today by Jerry Allen of Keller Williams Brazos West, Heather Kingston, Realtor of the Cates Group, and Gary Pierce, founder of Pure Funding. Thank you all so much for being here with us today.
Thank you.
Yeah.
For our very first question, we'll begin with Jerry, and the subject is relistings. The question reads, why do properties sometimes come back on the market after it's shown to have a contract on it?
Well, there's a lot of reasons. Typically, you go ahead and you list a property. It comes on the MLS. People see it, and they go ahead and they will go ahead and start doing showings on it. Somebody will put it under contract. Usually it's an active option contract, which means they put an option on the property to be able to hold it for a certain amount of days. In this market, usually 5 to 7, possibly 10 days. During that time, they get the unrestricted right to be able to choose to continue the contract or not. And say, for instance, they go in the backyard and they say, that looks like a grave in the backyard. I don't think I want that. They can pull out for any reason, even bad pizza the night before. They don't have to have a reason. And they don't have to specify the reason. They just say, I'm out of here, I'm done. They lose their option fee, and then it goes back on the market. So on the MLS to realtors, it will say AOC, which means active option contract, and then it'll say active. So it goes back to active. To the general public, they just see, hey, it was under contract, now it's not under contract, what's the deal? So that's how that happens. Or it can be under contract, go through the option period, which means it's past that 5 to 7 days, and continue on into other things. There can be title issues that come up, and people can say, well, I'm not okay with that. We can't cure this title issue, so I get to go ahead and cancel the contract. That can happen. Financing issues. Perhaps the property doesn't appraise for value, so that the contract can be terminated at that point, and then it comes back on market. Usually you'll see that as like one's been on the market for 10 days and it goes under contract. And then it's been on the market for 60 days and it came back out, and so it's back on market again after being on market for 60 days. So that happens a lot. And in this market, when we've had these increasing interest rates, people that were able to qualify 2 months ago and they had to go ahead and try to go ahead and get everything else in line, suddenly they're no longer able to make their payments on that, so they can't qualify. They can't make the payments on the rate, so the property comes back on market. So there's a lot of reasons for that. But usually it happens in the option period. Somebody will see an inspection and go, yeah, I'm not okay with that. I can't deal with that. And they'll decide to move on.
Okay, thank you.
You're welcome.
Mm-hmm. Our next question is for Heather, and the subject is livestock. The question reads, I've been considering buying a small ranch for my retirement years just for fun, but a friend mentioned to me that I would need to keep and care for a certain number of animals. I couldn't just own a ranch. Is that true?
Well, my follow-up question would be, what tax burden are you comfortable with? Because if a ranch could mean 300 acres, a ranch could mean 10 acres here. So what tax burden are you comfortable with? In Texas, we're taxed based on the use and the value of the property. So if I have 10 acres at a house, like I personally have, I can't get ag exemption unless I'm doing some sort of agricultural production, and I have to prove it. And the house and the property has to have been in that use and producing something for 5 out of the last 7 years. So I've tried to get ag exemption. I've been denied twice because we don't have goats and cows. A good general rule of thumb is 2 large animals per acre or 6 smaller animals per acre. So you could do it through animals, but you could also do it through coastal production, because if you are producing hay and selling hay on the market, that is 100% an agricultural production. So yes, you can use that. So it doesn't have to be animals. I mean, even chickens and bees will qualify you, but Parker County specifically says your usage needs to be pretty equivalent to the neighbors around you. So if you have a neighbor across the street with the same type of acreage, like 25 acres, and they have 30 head of cattle, the county would really want you to kind of follow that same standard. I don't know what the rule is on how many bees or honey production, but I'm sure there are rules. And usually the minimum acreage size is 10. Sometimes you can get around it. I remember a story, Parker County, he said this woman had 5.5 acres and she swears she was a full producing orchard. And he was like, there's no way. And they went out there, looked at the property, and sure enough, I mean, she had hundreds of peach trees on this 3.5 acres, and she was granted the variance of getting that ag exemption on a smaller property. So you have to produce a certain amount to be qualified with a smaller acreage, and it's very difficult to do. So there's a lot to it. There's a lot to it, and every county is a little bit different. So the best thing to do is to call your tax district, find out who is in charge of your specific area and neighborhood, and ask them all of the questions that you have. And they, by and large, they're very helpful and can help you get there.
Thanks, Heather. Our next question is for Gary, and the subject is changing loans. The question reads, can an individual take a conventional loan and then swap out to an FHA loan? If so, how would that be handled?
So good question. I think the best way to answer it is what loan is best for the client at this time, right? So if somebody, typically you're going to go from an FHA to a conventional because the pricing is much more favorable towards the client. Fees are a lot less. A lot of different factors. The FHA loan is a great loan. It's a government-backed loan. Typically, you're not going to go from a conventional loan into the FHA because it's going to come with some fees. There's higher mortgage insurance typically on those loans is higher. There is what they call a funding fee that is rolled into the loan as well, and it's basically insurance. So to get really technical, it's the 203B insurance that insures the FHA loan that allows that loan to be written from a FHA perspective. But typically you can, in a refinance situation, you can move from loan product or loan type to different loan types at any time. But it just has to make sense for the client.
Thank you. Our next question is open for debate and discussion amongst the panel, and the subject is commercial to residential. The question reads, is it possible to purchase a large property such as a school or offices and convert them to several residential properties? And what obstacles would have to be overcome?
Good question.
A lot to that one.
Do you mind if I take that one to start with?
Absolutely.
It's one that's been on my heart ever since COVID hit. We've had, ever since COVID hit, people didn't go to work. And we've had a big vacancy rate in commercial buildings, to where a lot of the commercial realtors just had to go under. The buildings got retaken back. I've always thought that what we should probably do is take some of those commercial buildings and turn them into residences, because at the same time, a lot of people lost their homes, lost their jobs. They need somewhere to live. The obstacles to it are obvious ones. You know, you take an office building, you're going to have to outfit it for residential use, so that's not going to work really well. They do have common kitchens and things like that, so it's kind of it might work for a community house or something like that, but for regular residential it'd be a lot different. Zoning with cities, that's a big thing, because it's kind of like the Titanic. If you want something done with the city, the Titanic goes at this slow speed, at this rate, and if you want to make a change, they go, that's nice, we're going to barrel right over you and keep right on going. What we really need to do is be able to have a function that can be like a PT boat. I'm going to go over here and you say, you need a change? Okay, great, you need a change? Yep, okay. But that doesn't work like that. And legislation would have to change so that we would be able to respond a little quicker, to be able to rezone things so that they could be residential. Just take, for instance, Dallas. We've got downtown Dallas has all these great commercial buildings, and we got homeless people all over Dallas. You could house those people easily, and the funds that Dallas has, they could do that. But in order to make that happen, if they decided today to do that, it's going to take 5 years for them to pass the legislation to be able to get that to happen, and then it can happen. In the meantime, you got more homeless people.
So anytime you change use for a property, it has to be approved by the city. If you're inside city limits, it has to be approved by the city. So that's quite a long process. You have to go to the city, you have to go before city council. Sometimes you have to go before city council multiple times. You have to go through the fire marshal's inspections and all of that red tape in order for you to do that. And the city's going to have all of their rules that are like, well, okay, if you want to change this from this commercial building to multifamily, because essentially that's what you'd be changing it to, is a multifamily use. There's going to be all sorts of rules that go with that. And it's going to be different for every single city. Some cities are much more open to it than others. And it's a long process. So just be prepared for that to take months and months and months. And you probably don't want to go under contract with a property with a short time period to where you can back out and receive that earnest money back until that change of use is approved by the city. So with a commercial contract, it's a little bit different. It's longer. In residential, you have the option period, which is the irrefutable right to terminate for any reason. In commercial, it's called feasibility. And for something like this, you're going to want a several month feasibility period to go through those city council meetings and meeting with the fire marshals and everything else that you need to do in order to get that approved. So it is a lengthy process, but possible, but difficult, depending on the city's rules. So
Time consuming.
yeah. What about loans for that?
So loans for that, obviously to acquire the building, that's going to be a commercial loan, so it's not going to, really fall on any residential aspects at all. So where it would become residential is once you did all that work and you get through the feasibility and you get the building acquired and you decide, hey, I want to make this a townhouse or a condominium environment, so multifamily type from that sense, then you can come in with, conventional financing for townhomes or condos, and folks can go in and purchase the units that way. So in Fort Worth, for instance, the Montgomery building kind of comes to mind. That's an old kind of a warehouse that was, renovated and refurbished to become kind of high-end condos. And so that's, an example of what you could do there.
Mm-hmm. Thank you all very much. Don't go anywhere. We'll be right back after the break to answer more of your property-related questions.
Howdy folks, I'm Jerry Allen, Global Realtor with Keller Williams Brazos West. I am your go-to guy for all things real estate. Whether you're looking for a piece of land or a large ranch, first home, next home, dream home, or your last home, I can guide you through the process till we find what you want. It's service like that that's kept me a top area producer for many years now. For more information, visit me online. Remember the name, Jerry Allen. Let's fulfill your next dream together.
Hi, I'm Heather Kingston. Showing land on these ranches that we have out here in Parker County is one of my most favorite things to do. Come on, let's go take a ride. When choosing a buyer's agent, you have to have someone who has geographical competence and a vast knowledge of the area that you were choosing to purchase in. As a listing agent, my focus is to net the most for my sellers with the least amount of risk. That's such an important part of my job. And with a background of photography and videography, I bring everything to the table that we need to market your property to the best of our abilities.
Hi, I'm Gary Pierce with Pure Funding. We're proud to serve Texas and, more importantly, Parker County as your go-to residential and farm and ranch mortgage broker.
That's right. I'm Willis Richardson, and with our passion, products, and process, we'll get you to the closing table on time.
Give us a call or come by and see us. We're located right off the historic square in downtown Weatherford.
Or you can visit us first at our website at www.mypurefunding.com.
Welcome back to Property Question Time. I'm your host, Taylor Welch. I'm joined today by Jerry Allen of Keller Williams Brazos West, Heather Kingston, Realtor of the Cates Group, and Gary Pierce, founder of Pure Funding. Thank you all for being here with us today.
Thank you.
You're welcome.
Our question is for Gary, and the subject is 203K loans. The question reads, what exactly is a 203K loan, and can anyone apply for one?
Absolutely. So a 203K loan is a loan that combines two aspects of a purchase. So if you're looking at properties that are maybe needing some rehab or renovations, this is a great loan. So it's essentially backed through the FHA. It's written just like an FHA loan, so it has a lot of those components to it. So the appraisal and those sort of things are going to be kind of FHA guidelines and standards. The second piece is the rehab. So let's say you're going to buy a property for $200,000, but it really is worth about $250 to $300. But because the property is in a condition that needs some upfitting for whatever reason, the loan will allow you to then finance that portion of the loan. So you can have the purchase price of $200,000 to get the property acquired, and then you'll also have the piece that will allow you to do the rehab. Obviously, you'll have to work through an approved contractor and go through the draw process for that. But it's a great way for buyers that are looking to find homes in areas that are needing fixer uppers essentially. So it's great product.
How long does a loan like that take to close compared to a regular FHA loan? And do you have to show proof of all work completed throughout the process?
Yeah. So the loan typically will take 30 to 45 days. The rehab is a little bit trickier. Today, appraisals are coming back pretty quick, so we're getting the benefit of that. So the actual underwriting of the loan isn't taking as much time, but with the rehab, there is the contractor approval. You've got the budget approval, making sure that the client isn't getting into a situation that they're asking for too much, or it also meets the loan to value requirements as well. So 30 to 45 days is kind of the norm on that.
Thank you. The next question is, what is earnest money for Jerry?
Earnest money is, they used to call it honest money. And that meant I'm putting this up as good faith money to show you that I am serious about making an offer on your property. You put down typically 1%. You can do more, but typically a minimum amount would be 1%. Anything less than that, unless it's a VA loan or something like, because VA doesn't require you put anything down. The seller might, but you don't have to put anything down. And that's money that's held by the title company. You write the check directly to the title company, and they hold it. They cash it, but they hold it until the contract goes to fruition or you cancel it during your option period. And at that time, if you canceled it during your option period, they would cut you a check back for your earnest money, and the option money would go to the seller. So they get to keep that. So as soon as you sign the contract, the option money's gone. Kiss it goodbye. That's the only money that the seller is guaranteed that they're going to get. So sometimes that can be the difference between getting a contract or not getting a contract. So you've in the last hot market, you've seen some pretty high option fees. And somebody might say $1,000 option fee for a 5-day period. Okay, well, if I'm the seller, I'm going, what's the worst that can happen? I make $1,000, great. But they're putting up as much as 20% for earnest money. The earnest money is not, people think, okay, I'm out this money and I may not get it back. Well, that's possible. But the only ways that you don't get it back is if you change your mind after the time that you're allowed to change it, and not for any reason that you're allowed to change it for. And it didn't come back for financing, or the appraisal came back short, or there were problems with title. Once you get past the option period, it's kind of tricky to get out of it. So you want to be very sure that you write the contract properly and you have a good realtor.
Right.
Yeah, and the earnest money, from a lending perspective, is just going to roll into your cash to close. So you're going to have that less, whatever your cash to close, it'll be less the 1% or whatever. So you don't have an additional percentage to bring to closing as well.
Credited to the buyer at closing.
Right.
Yeah.
All goes to your down.
But if you do change your mind, which I had happen to me recently on a $400,000 house, 3 days before closing, the buyer just changed his mind, didn't want to be on the loan, only wanted the other person to be on the loan, and they walked away from $10,000 of earnest money.
They lose it.
That went to my seller. So it took the pain away from that contract terminating so late in the game, because that was, that's a pretty devastating thing to have happen to a seller.
At that point.
Yeah, and it helps with their carrying costs. I mean, that's part of the purpose, is the buyer has some skin in the game, right? And then if it terminates, the seller has something to help with their carrying costs, because now they have another mortgage payment. They have, more property taxes that they're responsible for. Yeah. So, yeah.
And it's pretty much the only money the title company gets to make. They get to make interest on the money that they hold for the earnest money for the whole time until the contract closes.
Thank you all for your response. Our next question is for Heather. It's about surveys, and the question reads, When should a survey be done in the timeline of buying or selling a property?
Well, hopefully the survey was already done prior to going on market. But there's a lot of times when it hasn't been, or they can't find their survey. So for those people that don't know, a survey is essentially a bird's eye view on paper of the property. It shows the boundary lines, it shows the road frontage access, and it shows where all of the permanent structures are on the property. So a pool or fencing or the home, the driveway, the sidewalks, everything, just to make sure that all of the improvements that are on the property are actually within the boundary lines of the property. Recently we closed on one that had the boundary line 8 feet over into the property that we were buying. So the neighbor owned 8 feet of the yard that was in the property boundary lines. So that was really scary to my buyer, and after talking to an attorney in the title company and really understanding what the ramifications could be, the buyer felt comfortable moving forward. But it's always risky purchasing something where the boundary lines and fence lines are off, because that could come back to hurt you after closing. Or if this property ends up selling and now this neighbor's like, what? I lost 8 feet of my yard. I want you to move the fence. That's where it comes to play. So it's super important to have the survey done. But as far as timeline, I typically, if there's not a survey already completed, I typically don't have them order the survey until we're out of that option period where they have that right to terminate for any reason. Once we get past that, it's a safer time to order that survey.
Yeah, they're definitely.
Go ahead.
Yeah, and it's super important from a lending perspective and a title perspective, because the lender and the title company wants to know what they're insuring from a policy perspective, and the lender wants to know, what is the property that I'm, lending against, and so that gives the legal definition of that. And then in Texas, when you do certain refinances, cash outs specifically, you can't use a property survey from like 25 years ago. You have to have a more recent survey done. So it's surveys are very crucial, very important pieces to the transactions, whether it's a purchase or a refinance.
And when you actually go under contract, there's a portion in the residential and also in the farm and ranch contract that says that you have a survey, if you do have a survey, and you sign a T47 affidavit that says, from the time that this survey was done, I haven't done anything that will change the property lines, and you just get that notarized. Typically, that's something that you want to go ahead and give to the potential buyer within 3 to 5 days, usually, if you have one. Then also in the farm and ranch contract, there's a portion that deals with shortages in the area. If you go ahead and you have the contract done, the survey was old, you can't do that. Gary says, now you got to get me a new survey. Okay, great, fine, we'll get you a new survey. You get the new survey, and it turns out that there's 1.5 acres less than what you thought you were buying. Well, the contract allows you to offer a prorated amount that's less than that by that 1.5 acres, and that's in the contract, and you agreed to that. So it can be expensive, and usually it's not any more than 1.5, 2 acres at the very most on a really large property, because surveys are pretty good, and even the meets and bounds surveys that we have in West Texas are pretty good. Reading them is an adventure in itself. 3 steps to the left, roll over twice, throw a rock over in that direction, and where that thing was, that's where the line is. It's not quite that bad, but it's kind of interesting. You read the old surveys, it's a lot of fun.
Thank you all very much. Our next question is also open for discussion amongst the panel, and the subject is power outages. And the question reads, it seems that every year the threat of power outages for long periods of time during bad weather are becoming real. Are there any viable options that homeowners can investigate to reduce the likelihood of being hour after hour without heat?
Ice-mageddon.
Yeah, exactly.
Ice-mageddon.
Yeah, what was that, a year ago? 2 years ago.
I think it was this last winter, wasn't it?
We had it twice, yeah. And we had, I had a property that was under contract, had a beautiful pool, and it went under contract on Valentine's Day, which was the day Ice-mageddon hit. And the people went out to look at the property, and there was no water in the pool. It had cracked, and all the water had drained out. But that didn't have anything to do with the power. We can do solar panels And that's a really neat thing, but it comes with its own set of issues. And it's been a long time a standard in Texas to use generators. Hospitals have had generators because they can't afford to be down. You know, the power goes out, it's like, we've got surgery going on, we have to have power, that's got to continue. So the generators immediately come on, and they're gas powered. And some of them can be solar powered, but I don't think I'd want one of those guys. No offense to the solar people. But the gas generators will go ahead and come on immediately. Once the power goes down below a certain point, they'll kick on and add to that power grid for the hospital so that they can continue to have the same thing's available for houses. And whenever Ice-Mageddon hit, everybody went to Home Depot and Lowe's and stood in line and bought every generator there was possible to be able to get, because it's like, I got to put this thing over my house because my heater has to be on. I've got to have heat, and I can't, I don't get enough heat with my fireplace. So, that's long time been a staple here in Texas. So if you invest in generator stock.
I agree. And, okay, so I get questions weekly about solar panels. The solar panel salesmen are just really hitting the front doors of like every client that I have. And they're promising some things that I completely disagree with. These people are telling my clients, just in the experiences that I've had recently, that it will increase your home's value by 25%. And so my client's first question is this going to increase my property by 25%? And my answer immediately is no, it is not, because there has to be data to show that this house with solar panels sold for 25% more than all of the houses around it without solar panels. And that data does not exist, especially not in our area. So, there's quite a few more things I could talk about solar. The other thing is you got to be careful because it's going to increase your homeowner's insurance by a ton. Mm-hmm. It's going to increase the value of your home with your homeowners, not necessarily the market value, but your replacement cost for your home. Because now you have these solar panels, it's going to increase your deductible substantially, because now your homeowner's insurance has to pay to remove those panels, replace the roof, and pay to put the panels back on. So their cost has gone up substantially. So those are costs that these solar panel guys are not talking about. And you also have to be extremely careful because their contracts are very tricky. I ran across a property in Fort Worth. I had some clients that wanted to buy it. There were panels existing. It was a 40-year lease on these panels. These panels, you couldn't even pay them off at closing. And that was extremely frustrating. The way this was written, you had to lease it for 7 years, and maybe after 7 years, then you could pay it off. So whoever was purchasing this home had to apply for financing, which could screw up the loan, because now you're opening a new credit account to be qualified for these solar panels just to buy the house, because we couldn't even have the seller pay them off at closing. So they're very tricky. And then the other part of it is how it is set up. Is it going to a battery bank or a Powerwall that's owned by Tesla or whatever? Or are they going back to Encore? Because I have clients who have purchased it, they credited it to Encore, and I don't know this, but I wonder if the solar panel companies get paid more to have it set up that way rather than just going into power banks, because Encore usually gives you a credit pennies on the dollar for what you're charged for that electricity. So you get a credit, but then you still have to pay for electricity with Encore, but you're not credited what you're actually given. So there's a lot of research to be done with solar panels. Don't jump right into it thinking they're the best thing. And a lot of times people think that they're just plain ugly, and it actually decreases your value in a buyer's eyes because they don't want to look at solar panels. So there's a lot to think about before making a decision, but I would 100% go towards a whole house generator. I think that that's a much better investment, and I think buyers love that, especially after the Ice-Mageddon.
The other thing that, as you're thinking about either refinancing or purchasing a home, is the solar panels come with a mechanics lien. So regardless if they're leasing them or not, we see it all the time when we get a title commitment back where there's a mechanic lien for solar panels, and the client will say, well, I paid that off, or I don't have a loan, but it's still, the company still placed that on there. So it's always good to know, kind of what those liens are on your property, obviously, because that can be a snag in the lending process, whether you're refinancing or purchasing. So something to think about.
Certainly. Thank you all very much for your answers. Sadly, that's all the time we have for today, but please keep your questions coming. You can send those in via our website, PAX180.com, or by emailing pqt@paxtelevision.com. My special thanks today goes to our panel of industry experts. Thank you all so very much again for being here with us today.
You're welcome.
Thank you.
And thank you for joining us on Property Question Time with me, Taylor Welch. And we'll see you next time.